Thank you for the introduction, Jonathan, and thank you for the opportunity to speak at this wonderful conference yet again. I'm going to make the most of it because according to an article I read just a few weeks ago, there's about a 50-50 chance that economists are going to be replaced by computers at some point over the next 20 years. I know what you're thinking. How on earth could they build the computer that could be as indecisive and error-prone as an economist? But technology is a remarkable thing. So until I get replaced by a cyborg, you're all mine. And I want to talk for about 25 minutes to talk about the economic environment and what it means for the hotel sector. And really, I want to cover 3 points. First of all, I want to talk about the fact that the UK economy, the US economy, continental Europe and Japan are all in a better place than they were this time last year. I then want to think about what that might mean for the next 5 years as we start to normalize monetary policy. So once we stop pumping liquidity into the system and once we start raising interest rates, what does that mean for asset prices here? What does that mean for asset prices in emerging markets? And could these be the banana skins that Jonathan spoke about? And then I want to wrap up by looking through the cyclical ups and downs and focusing on structural factors. And I want to close with a piece of analysis that I think suggests that the outlook for the hotel sector over the next 20 years really is second to none. And there are a lot of reasons to be very excited about the enormous opportunities that we can expect to see. But first, let's start by considering the performance of the developed markets that count for about 75% of global tourism and ask, are we in a better place than we were 12 months ago? And if we look at the growth rates for Japan, for the UK, for the US, and for the Eurozone, we see across the board, these growth rates have picked up. Now that pickup means different things in different parts of the world. In the Euro area, it's a story of going from recession towards stabilization. In the US, the pickup has been relatively small, but that's mainly because the US was in a much better place to begin with. And we take into account the massive fiscal headwinds that the American economy faced in 2013. Even that small acceleration really does look quite impressive. And then really big turnarounds in terms of the growth rates that we're seeing in Japan and in the UK. So when you put all that together, and you've got these countries growing on average by about 2%, 3% year on year, people are rightly starting to ask the question, do we really need monetary policy set at emergency levels? When you've got growth of 2, 3%, do you really need interest rates at rock bottom? Do you really need to be pumping money into the economy to try and boost asset prices? And this is the question that's dominating the economic debate, and I think that's going to dominate the next 5 or so years for the global economy. And if we just look at some of the conversations that are happening around the debate, it really is quite interesting. So if we take the UK, for example, and compare where we were with where the outlook for interest rates compared with where we were a year ago. So this yellow line shows where we were at the time of the conference last year. Rate hikes were expected, but not really until 2016, and gradually thereafter. Now rate hikes are expected to start in 2015 and to happen at a slightly quicker pace. Now the difference isn't huge, but by the end of 2017, UK interest rates are now expected to be fully 1 percentage point higher than they were. So people are already starting to get their heads around what it might mean as things start to normalize and what's going to happen to the cost of borrowing. We've seen a similar debate in the US. It hasn't been so much about interest rates as it has been about quantitative easing, this policy of the Federal Reserve pumping money into the US economy. They've announced, in fact, they've already started tapering the rate at which they pump this money in, so they're expected to be done by the back end of this year. They haven't started tightening, mind you. We're still looking at $400 billion being pumped in 2014 by the Federal Reserve. So we're still talking about stimulus in the US, albeit one that is gradually going to wane, and so that by the end of the year, that stimulus ought to have peaked. Now, this is a good thing. We have these emergency settings for monetary policy because the economy was in crisis. If we're talking about relaxing these emergency settings, it's because we're talking about an economy that is no longer in crisis. So like I say, it's a good thing. I think we should welcome this normalization. But I do think it would be naive to think that we can manage this transition seamlessly. You don't go from having the greatest policy experiment in the history of the global economy. You don't emerge from something like that without a few bumps along the way. And this is where I want to start talking about these banana skins that Jonathan alluded to in his introductory remarks, because I think this process of normalization really could be a bumpy ride. As we see this unconventional monetary policy start to ease, investors, companies, consumers, governments, we're all going to have to get our heads around what it means when interest rates are no longer at rock bottom. And I want to think about two potential consequences of this normalization. I want to talk about what it means for emerging markets, because I'm sure you're already aware we've seen quite a lot of turmoil in emerging markets over the past 9 months or so. But before that, I want to think about what it means closer to home. I want to think about what it means for asset prices in developed markets. And the reason that I want to do that is because I think the revival that we've seen in asset prices over the past couple of years has been vital to the recovery that we've seen in the US and the UK and all those countries that I showed earlier on. But what's interesting about the recovery that we've seen is how uneven it's been. So since the US economy started to recover in 2009, real inflation-adjusted spending by the top 5% of households in America has increased by 17%. For the other 95%, it's increased by just 1%. So a really, really uneven distribution of growth that we're seeing in America. And it's not difficult to see why, because that top 5%, their spending patterns are massively dependent on the performance of equity markets and the performance of the housing market. US equities went up 30% last year. US house prices on average went up 15%. The growth that we've seen in asset prices, which is not entirely, but in large part a consequence of this unconventional monetary policy, has been a real shot in the arm for this small but affluent slice of consumers that are driving the recovery in the US. And as a result, I think we have to think about what it's going to mean for that small but affluent slice of consumers once this unconventional monetary policy starts to be unwound. We've already had a glimpse of what it might look like. Equity prices hit an air pocket in January. House prices were fairly soggy in the back end of 2013. And it remains to be seen whether or not this is going to start affecting consumer spending going forward. But we've seen it across a whole heap of sectors in the US economy. Retailers, restaurants, certainly hotels, where we're seeing revenue per room growing almost twice as quickly in high-end properties as it is in mid-scale properties. And it's not just a US phenomenon. It's happening around the world, but particularly in the UK. If we look at the pattern of growth in the UK, we see a similar story. This small slice of affluent consumers driving the recovery. And to see the vulnerability that I think that entails, I want to look at consumer spending by income decile in the UK. So all this does is it takes the 26.5 million households in the UK economy, splits them into 10 equal groups, and looks at how much of total consumer spending they account for. And what you see is that gradually, as you go up through the deciles, so as the deciles get progressively richer, their contribution to consumer spending rises. And there's a real kick up just at the end for that top decile. So the top 10% really are punching above their weight in terms of their contribution to spending. Now I want to see what happens when, instead of looking at aggregate consumer spending, we look at spending on foreign holidays. Same pattern, but that kick up is even more pronounced. The top 10% of UK households account for 50% of total spending on foreign holidays in the UK. So if we take that 26.5 million households, that top 2.5 million households do as much spending as the other 24 million put together. There has to be a vulnerability in that. It's been great news for the hotel sector over the past couple of years. It's one of the reasons why the hotel sector has significantly outperformed UK GDP over the past year or so, growing at about 4 times as quickly. But there has to be a vulnerability, not just for the hotel sector, but for the economy as a whole. Because when you've got a recovery that is so concentrated in one part of the consumer sector, you have to ask yourself, in a recovery when so many people are being left behind, can we really call it a recovery? We might be able to muddle through, leave recession behind, post some reasonable growth rates, but can we get a proper recovery without the lower income deciles also seeing an improvement in their incomes and that translating through to consumer spending? We're going to find out. I don't think that we're going to see a sharp correction in asset prices, but I do think we're going to see increased volatility as we exit this unconventional monetary policy, this bumpy ride that I think that we can expect. And as a result, I think it could be quite volatile for the UK economy, for the US economy, and certainly for the consumer-related part of spending in the hotel sector. So far, really, I've focused on developed markets, the US, the UK, a little bit about Europe and Japan. I want to shift things a little bit now and think about what's happening in emerging markets. And if we look back over the past 9 months or so, we've really seen the beginnings of quite a painful correction in terms of emerging markets. Almost to the day that Ben Bernanke, the chair of the Federal Reserve, started talking about tapering their quantitative easing program. So this process of gradually pumping less and less money in to the US economy, it sparked this fundamental reappraisal of the risk level in emerging markets. We've seen double-digit declines in exchange rates for, I've showed the so-called fragile five here, Turkey, Indonesia, Brazil, South Africa, and India. But really, it's been much broader than that. Countries like Argentina, even China, have not been immune to this reappraisal of risk and this rethinking of what the outlook might mean for emerging markets going forward. And it's difficult for us all to know what to make of this, because for much of the past 5 or 10 years, the underlying narrative when thinking about the global economy has been that a presence in these markets was a prerequisite for any self-respecting or vaguely ambitious company. Now, everyone's getting jittery. They're talking about the 1990s and the series of crises that claimed Mexico, Russia, and many Asian countries, and wondering if the same thing is about to happen. And it's difficult to know really which of these views we're now supposed to shape our investment strategies going forward. As usual, I suspect the answer lies somewhere between the two. I think it's unlikely that we're going to see this morphing into a full-blown crisis like we did in the 1990s, for the simple fact that emerging markets are just in much better shape than they were 10, 15 years ago. And as a result, I think they're much more able to withstand any external shocks that might come their way. But I think we have to be realistic as well. I think the days of the turbocharged, credit-fueled growth that we've seen over the past 5 years or so are at an end. So far, really, it's only been FX markets and equity markets that have borne their brunt. We haven't seen much of a follow-through to the real economy yet, but I do think that's going to come. I think the emerging market economies are going to see a pronounced downswing in the growth rates that they experience over the next 5 to 10 years. They'll still grow more quickly than the developed markets, I suspect, but I think that gap is going to narrow. And that's quite a challenging environment for emerging market investors, because differentiation all of a sudden becomes increasingly important when you can't rely on this deluge of money to be a rising tide that floats all boats. And as investors start to think about differentiation, I think increasingly they're going to find themselves asking one question when they think about emerging markets. What is it that these countries are emerging into? Emerging into what? Do they have a clear sense of commercial sense beyond maybe exporting commodities or something like that? Do they bear the hallmarks of good government that give you confidence that their infrastructure and their institutions are going to keep pace with whatever rate of growth that they see? That increasingly, I suspect, is going to be the focus for investors going forward. And increasingly, this differentiation will be brought sharply into focus. So all told, I'd rather suspect that we're looking at a more challenging environment for emerging market investors over the next few years. But I don't want to appear too downbeat, because I still think that the structural opportunities in emerging markets, particularly for your sector, are enormous. And to give you an idea of just how enormous I think they are, I want to share a really first-rate piece of research that was done last year by those clever people at Goldman Sachs. I would go so far as to say this was probably the best piece of economic research that I read last year, and as you can imagine, I read a fair old bit. But before we do that, before I share the results, we need to talk a little bit about sweet spots. What's a sweet spot? If we look at the pattern of demand and the relationship between demand and income over time, it tends to follow an S shape. So to begin with, you go through this fairly long period where increases in income don't tend to actually change demand all that much. Then you go through this period of really rapid growth where for every additional dollar or pound or euro or whatever of income, it translates into really large increases in demand. And then it levels off. You reach saturation where no matter how much richer you get beyond that point, your demand for that good or service doesn't really change. And the sweet spot is this point here. It's the point on that curve that is the steepest. That's the bit on the roller coaster when your heart is in your mouth and you're wondering when it's going to finish. And the point about different areas of spending, different goods and different services, is that that sweet spot occurs at different levels of income. In some goods and services, it appears at relatively low levels of income. For others, at higher levels of income, that's where the peak comes. And what the clever people at Goldman Sachs have done is they have joined all those dots. They've traced out what they call their ladder of spending to try and look at what consumers tend to spend most of their money on at what income levels. And they've called it, like I say, their ladder of spending. And this is what it looks like. You see, to begin with, when countries are poor, they're focused on commodities. Foods, gradually progressing to energy, eventually towards hard commodities like copper. Then about $10,000 that is when the age of durables starts to kick in. Washing machines and cars, dishwashers and better cars, luxury cars no less. And then about £30,000, or $30,000, sorry, that is when the focus shifts from durables towards services. And right at the end, the very pinnacle, is where you guys come in. Domestic tourism at around about the $35,000 mark, and then international tourism around about the $50,000 mark. So what are we supposed to make of this? Well, I take three conclusions from this, and the first conclusion that I take from this is that there is an awful lot of growth to come in the tourism market over the next 20, 30 years. The guys at Goldman Sachs are very careful not to call this a forecast. It's a projection. It's a systematic way of trying to think about what the world might look like. But the numbers that they have in over the next 20 years are for international spending to grow by 268%. So somewhere between trebling and quadrupling in terms of the spending that we see. That's a phenomenal amount of growth to have out there. The other point we need to think about is, where is this growth going to come? And that's where I think it really starts to get interesting, because if we look at where the growth is going to come over the next 2 decades, according to them, about 50% of it will be in emerging markets, and about 50% of it will be in developed markets. That's a massive change for the hotel sector, for the tourism sector more generally, to get its head around. If you look at these numbers, we're seeing almost as much growth over the next 20 years in China as we do in the Eurozone. About as much growth in the next 11, the N11, this group of countries that are supposed to follow the BRICS and dominate the 21st century. So Mexico, Indonesia, South Korea, Nigeria, Turkey, and a bunch of other ones. As much growth from the N11 as from the US. And then almost as much growth, more in fact, from Russia than from Japan. So really you're seeing this massive contribution to global growth from emerging markets, much more than we saw over the past 10 years. It's a terrific opportunity, but it's a lot for the sector, I think, to get its head round. But the other interesting thing I think we need to stress, and the third point that I would make about this research before I wrap up, is that as fantastic as these growth rates are, and they really are, at least in my opinion, fantastic in terms of the change we can expect to see, they are less pronounced than they are in terms of spending on other areas. China, India, these countries, they're entering the age of durables for them. The focus for them isn't yet going to be on tourism and on hotels. It's going to be on dishwashers. It's already on cars. We're seeing that coming through quite strongly. So as pronounced as the effect is going to be in hotels, and it's going to be huge, it's going to be even sharper in durables. And I say that for two reasons. One, just for a general sense of perspective. But the other one, I guess, is as you're thinking about the corporate market and where your customers are most likely to be over the next 10 years, certainly, you want to be thinking consumer electronics and you want to be thinking cars if this analysis is reliable in any way. You can't see it, I can see it. There's a little timer here, so I'm starting to run out of time. So I'm going to move to wrap up. But before I do that, I just want to quickly say a couple of other things. I'm going to be on the RBS NatWest stand from 4 o'clock until 5 o'clock today, if anybody wants to come by and talk about any of this stuff or ask any questions. And from day to day, from week to week, from month to month, I really would urge you to follow us on Twitter if you like. We post pretty frequently in terms of data developments we think are interesting, research that we find insightful, and charts that we think are memorable. So follow us on Twitter and hopefully you'll find that useful. But before I exit, I just want to quickly wrap up, really. Like I say, there was 3 key points that I wanted to stress today. First, the developed markets are in a much better place than they were a year ago. We should welcome that. It does mean that increasingly we're going to start talking about policy normalization, but like I say, we should welcome that, but not be so naive as to think that it won't be a bumpy ride. Don't be so naive as to think that we won't see increased volatility in asset prices as the world figures out and starts to learn again with interest rates that are no longer at rock bottom where they've been for the past 5 or 6 years. And then finally, to stress those huge structural opportunities that this fantastic piece of research from Goldman Sachs suggests lie for the tourism and hotel sector over the next 20 years. And this incredible rebalancing that we're seeing as emerging markets go on to become more and more popular. All that remains for me to do now is to thank you for coming, thank you for listening, and as I said at the beginning, 20 years from now or so, I'm going to be replaced by a cyborg, apparently. Jonathan, you'll be pleased to know event managers have a less than 1% of being replaced by consumers, so you're going to be okay even if I'm not. But in the words of my favorite cyborg, hasta la vista. Thank you.